It's March 9th, 2023, 9:42 a.m. Pacific Time. Silicon Valley Bank customers open their banking apps. Balances look normal. Savings accounts, checking accounts, business operating funds. Everything appears intact. By 9:47 a.m., withdrawal requests hit $42 billion. The bank had $25 billion in liquid assets. Do the math. By 11:03 a.m., the California Department of Financial Protection seized the bank. 16 hours later, the FDIC took control. 48 hours after that, Silicon Valley Bank no longer existed. This wasn't a hack. This wasn't fraud. This was arithmetic. Because when more people want their money than the money that actually exists, the system has a name for that: bank run. But here's what they didn't tell you in those headlines. Silicon Valley Bank wasn't an outlier. It was a demonstration of how your bank account actually works. Tonight, we examine the architecture behind the number you see when you check your balance, and why in 2026 that architecture is being quietly replaced. Open your banking app right now. You see a number, 4 digits, 5, maybe 6 if you've been disciplined. That number updates when you spend. It decreases when you pay rent. It feels real. But that number is not counting physical currency. It's displaying a ledger entry, a claim, a promise. And here's the part most people never calculate. As of January 20th, 2025, United States banks held $18.1 trillion in total deposits. That's the sum of every checking account, every savings account, every business account in the American banking system. 18.1 trillion. Now, here's the other number. Total reserves held by those same banks, 3.2 trillion. Let me say that again. 18.1 trillion in deposits, 3.2 trillion in reserves. That's an 82% gap. Your $10,000 balance, only $1,800 of it exists. The rest is somewhere else. This isn't a scandal. This is the system. It's called fractional reserve banking. And until March 15th, 2020, banks were legally required to keep 10% of deposits in reserve. 10%. On that date, the Federal Reserve reduced the reserve requirement to 0%. Zero, meaning your bank is not required to keep any of your deposit in actual reserves. Not 10%, not 5%, zero. This wasn't a headline. This was a footnote in a Federal Reserve press release during the early pandemic response. But the implications are structural, because when reserve requirements disappear, the only limit on money creation is bank confidence, not regulation. Confidence. And confidence is a psychological variable, not a mathematical one. So when you see your balance, you're not seeing a count of dollars. You're seeing the bank's confidence that you won't ask for it all at once. But what happens when everyone asks? Because in the last 18 months alone, 3 major American banks collapsed in the span of 8 weeks. And the system designed to prevent this didn't have enough money to cover it. So where did the money come from? Let's strip away the terminology. Fractional reserve banking sounds complex. It isn't. It's remarkably simple. And once you see the mechanism, then you can't unsee it. Here's how it works. You deposit $1,000 into Bank A. You check your app. Balance, $1,000. Feels safe. Now watch what Bank A does. Under the old 10% reserve requirement, they kept $100 and loaned out $900. The $900 goes to Person B. Person B deposits that $900 into Bank 2. Bank 2 keeps $90 in reserve, loans out $810. Person C receives that loan, deposits it into Bank 3. Bank 3 keeps $81, loans out $729. This cycle continues. After 10 iterations, your original $1,000 has become $6.5 trillion in total account balances. But here's the critical part. You still see $1,000 in your account. Person B sees $900. Person C sees $810. Everyone believes their money exists. But the actual cash, the base currency, is still your original $1,000. Everything else is ledger multiplication. This isn't theory. This is precisely how the 18.1 trillion in deposits was created from 3.2 trillion in reserves. The Federal Reserve tracks this. They call it the money multiplier. As of December 2024, the M2 money supply stood at $21.2 trillion. Physical currency in circulation, $2.3 trillion. The gap, $18.9 trillion, exists only as digital ledger entries, not as paper, not as metal, as data. And data can be edited, data can be frozen, data can disappear, which brings us to a question no bank wants you to ask. If everyone tried to withdraw even half their balance, would there be enough? The answer is mathematical. No, there would not be. And we know this because it's already happened multiple times. But the most recent example wasn't in the Great Depression. It was 11 months ago. March 8th, 2023, Silicon Valley Bank assets, $209 billion, 16th largest bank in the United States, profitable, well rated by Moody's and S&P, no fraud, no scandal. On March 8th, customers requested $42 billion in withdrawals. One day, $42 billion. Silicon Valley Bank held $25 billion in immediately liquid assets. By March 10th, the bank was in FDIC receivership. Collapse timeline, 48 hours. But SVB wasn't alone. On March 12th, Signature Bank was seized. Assets, $110 billion. Then First Republic. Assets, $213 billion. Three banks. Combined assets, $532 billion. All collapsed within 8 weeks. The cause was identical, simultaneous withdrawal requests exceeding available reserves. But here's where it gets structural. When SVB collapsed, the FDIC insurance fund held $128 billion. Total U.S. bank deposits at the time, $17.6 trillion. Coverage ratio, 0.7%. 70 cents of insurance for every $100 deposited. So when three banks collapsed simultaneously, the FDIC didn't have enough. They invoked something called the systemic risk exception, a legal provision that allows the FDIC to guarantee deposits beyond the fund's capacity by borrowing from the Federal Reserve. Translation, the insurance system needed a bailout from the money printer. The FDIC borrowed $188 billion from the Federal Reserve to cover uninsured deposits. $188 billion. That's more than the entire insurance fund. This wasn't reported as a crisis. It was framed as swift regulatory action. But let's be precise about what happened. Your deposits are insured by a fund that doesn't have enough money to honor its promise. So when the promise is tested, the insurance system borrows from the entity that creates money, which means the insurance isn't backed by reserves. It's backed by monetary expansion, printing, and printing has consequences. But we'll return to that. Because there's a deeper question here. Why does this system exist at all? Why design banking architecture that mathematically cannot survive mass withdrawals? The answer is historical. And it starts in 1913. Because fractional reserve banking wasn't always the standard. It became the standard after one very specific law passed. December 23, 1913. The Federal Reserve Act passes. President Woodrow Wilson signs it into law. The Federal Reserve System is born. Before this, banks operated on full reserve systems. Your deposit stayed in the vault. If you deposited $1,000, $1,000 remained. The bank could not lend it without your consent. But the Federal Reserve Act introduced something different. Centralized reserve requirements. Banks could now hold a fraction of deposits. The rest could be loaned out. The justification was economic efficiency. Money sitting idle in vaults doesn't generate economic activity. Lending creates growth. So fractional reserves became standard practice. 10% reserve requirement, 90% available for lending. This worked as long as confidence remained. But when confidence cracked, the system collapsed spectacularly. 1929 to 1933. The Great Depression. 9,000 banks failed, $1.3 billion in deposits lost. That's $23 billion in today's dollars. The government response. The Banking Act of 1933, also known as Glass-Steagall. This created the FDIC, Federal Deposit Insurance Corporation. Your deposits were now insured up to $250,000. The goal? Restore confidence. And it worked. For 90 years, people trusted the system because they believed the insurance was real. But as we just examined, the insurance fund is 0.7% of total deposits. It cannot cover simultaneous failures. It never could. The insurance isn't financial, it's psychological. It exists to prevent the question from being asked, and for 90 years, it worked, until 2023, when three banks failed in 8 weeks, and the insurance system had to borrow from the Federal Reserve. The crack in confidence wasn't repaired, it was papered over with newly created money. But here's what most people missed in those 2023 headlines. The Federal Reserve didn't just lend to the FDIC, they created a new emergency lending facility, the Bank Term Funding Program, BTFP. It allowed banks to borrow against their assets at par value, even if those assets had lost value. Translation, banks holding long-term bonds that dropped in value due to rate hikes could pretend those losses didn't exist. The program injected $165 billion into the banking system. This wasn't a bailout in name, but in function, prevent recognition of losses by creating liquidity from nothing. The program officially ended March 11, 2024, 1 year after SVB collapsed. But the precedent was set. When the fractional reserve system breaks, the solution is monetary expansion, not reform. Expansion. And that brings us to why the system is being replaced. Because every problem we just discussed disappears with one architectural change. Central bank digital currency. Let's be clear about what a central bank digital currency is. It's not Bitcoin. It's not decentralized. It's not private. A CBDC is a direct liability of the central bank, meaning your balance isn't a claim on a commercial bank. It's a claim on the Federal Reserve itself. No intermediary, no fractional reserve, no multiplication. You deposit $1. $1 exists in a database controlled by the central bank. This solves the bank run problem completely because there is no reserve fraction. There is only the ledger, and the central bank controls the ledger. So if everyone tries to withdraw, there's nothing to withdraw to. The money already exists as a central bank entry. No physical vault, no ATM limits, just code. The Federal Reserve published their first CBDC white paper in January 2022. They called it Money and Payments, the US Dollar in the Age of Digital Transformation. Not a proposal, a framework. In July 2023, the Fed launched the FedNow payment system. Instant settlements, 24/7 availability. This is the infrastructure layer. CBDC is the next step, but the US isn't leading this. They're watching others deploy first. China launched the digital yuan in 2020. As of October 2024, 260 million users. 17 cities operational. The European Central Bank entered the preparation phase for the digital euro in November 2023. Target launch, late 2026. The Bank of England, consultation phase ongoing. Digital pound targeted for 2027. India launched the digital rupee pilot in December 2022. 1 million users in the first month. This isn't theoretical anymore. This is operational infrastructure. And every central bank is using similar language. Financial inclusion, payment efficiency, reducing transaction costs. But read the technical documentation, not the press releases, the technical papers, because the capabilities listed include features that don't exist in the current system. Programmable money, the ability to set expiration dates on balances, geographic restrictions on where funds can be spent, merchant category restrictions. The European Central Bank's digital euro report from June 2023 explicitly lists holding limits and waterfall mechanisms, meaning if your CBDC balance exceeds a certain amount, it automatically converts to a commercial bank deposit or government bonds. You don't choose, the system does. The Bank for International Settlements, the central bank of central banks, published a report in September 2024 titled Design Choices for a CBDC. One section is labeled Policy-Based Smart Contracts. Quote, CBDCs could enable automated compliance with monetary policy tools such as negative interest rates or direct fiscal transfers. End quote. Let's translate that. Negative interest rates means your balance decreases over time if you don't spend it. Direct fiscal transfers means the government can deposit money directly into your account with conditions on how it's spent. Stimulus checks, but programmable. Spend it on food, allowed. Spend it on rent, allowed. Spend it on gold, blocked. This isn't conspiracy speculation. This is listed functionality in central bank technical papers, publicly available. Now here's the final piece. Why is this being deployed now? After 90 years of fractional reserve stability, the answer is in the debt. U.S. national debt, $36.2 trillion as of January 2025. Debt to GDP ratio, 123%. Interest payments on the debt exceeded $1 trillion in 2024. That's more than the defense budget. When debt reaches this level, governments face two options: default or inflate. Defaulting destroys credibility. Inflating slowly erodes purchasing power. But inflation is politically difficult when people can hold physical cash, or gold, or assets outside the banking system. A CBDC removes that friction. Because if all money is digital, and all digital money is controlled by the central bank, then monetary policy becomes frictionless. Want to implement negative rates? Done. Want to phase out physical cash? Natural transition. Want to ensure people spend rather than save? Program expiration dates. This is why central banks are moving towards CBDCs. They know this, which brings us to you. So here's where this lands. Your bank account shows a number. That number is 90% ledger multiplication, 10% reserves, unless your bank chooses 0%, which is now legal. That number is insured by a fund that covers 0.7% of total deposits. And when that insurance is tested, the solution is borrowing from the money printer. Soon, that number may not be in a commercial bank at all. It may be a direct Federal Reserve liability, programmable, trackable, controllable. Both systems have the same weakness. Neither is actually yours. One is a claim on a private institution that doesn't hold the full amount. The other is a government database, entry with programmable conditions. So what do you do with this information? Let's be precise. This is not advice. This is observation. Institutions are repositioning. Central banks bought 166 tons of gold in Q2 2025 alone, 41% increase over the usual quarterly average. Russia holds 2,336 tons. China holds 2,298 tons. India holds 880 tons. These are not reserves for payments. Gold doesn't facilitate transactions. It's a hedge against the system they're building. Meanwhile, household deposits into the fractional reserve system are at all-time highs. 18.1 trillion. That's the asymmetry. Institutions reduce paper claims. Households increase them. And that gap doesn't narrow by accident. So the question isn't, should you panic? The question is, do you understand the system before it transitions? Because transitions happen slowly, then suddenly. Fractional reserve banking worked for 90 years, until 8 weeks in 2023 when it didn't. The FDIC insurance worked for 90 years, until it needed a bailout. Systems work until they don't. And the people who design systems reposition before the public does. This isn't about abandoning banks. It's about understanding what your balance actually represents. A claim, not an asset. A promise, not a possession. And promises are only as reliable as the system honoring them. When that system changes, the promises change too. So watch what institutions do, not what they say. Words calm, actions reveal. And right now, the actions are clear. Your bank account is 90% fake, not because of corruption, not because of conspiracy, because of architecture. The system was designed this way, for efficiency, for growth, for control. And it worked, as long as confidence held. But confidence is not a constant, it's a variable. And variables change. In 2026, the architecture changes too, from fractional reserve to money masks to central bank ledger, from private claims to government code. The transition will be framed as progress, efficiency, security, inclusion. But the result is the same. Your balance becomes more controllable, more trackable, less yours. This isn't a prediction. This is observable infrastructure being built in real time. So the question isn't, will this happen? The question is, will you understand it before it's the only option? If this changed how you see your balance, leave a comment. Tell me what surprised you most and subscribe, because the next system is already operational.